Because I still hear people saying, oh, we're going to have a housing bubble. Not so fast, shipmate. Probably not going to happen. And here's why. Aloha, this is Larry Gonzales from Align Mortgage, a senior loan officer sales manager. And I'm going to talk to you today about my 2022 housing market forecast. Before I get going though, please like, subscribe, or comment on my YouTube page. The more you like it, the more I educate others. So let's recap 2021. All right, interest rates. The forecast for 2021 was that interest rates would rise at the beginning of the year and recover into the fall. Well, guess what? Rates actually did rise. They rose sharply from 2.25 in January for VA up to 2.875 for a period of about maybe a month, and then they kind of came back down, settled out, and we were in the low to mid twos for the rest of the year. Housing, the forecast was that we'd have a strong demand, tight supply, and home prices would push up, right, with high single-digit appreciation. What actually happened, though, was there was a huge demand, and there was an even tighter supply than we anticipated. Why was there a tighter supply? It was the 3 L's, land, labor, and lumber. That's right, the cost of lumber. Those prices plus COVID, all right, caused a strain on the housing market. The supply just never met the demand, and that became exponential. And we'll talk about that a little later. What are we looking at 2022? Well, there's a saying, you don't fight the Fed, all right? And the Fed is gonna play a major role in 2022. All right, they're talking about tapering, their purchase of mortgage-backed securities, they're talking about rate hikes throughout the year, and then now they're talking about a balance sheet runoff. All right, and I'm going to get into that a little later, but they're going to have a big impact, all right? It's going to have a big impact on the equity markets. It's going to drive interest rates up. It's going to impact, which will impact housing as well as jobs. All right, here's another thing. The last couple years, we've had Fed members who were accommodating, all right? They were kind of sitting back and letting things kind of happen. We have a more hawkish, we've had a big turnover in Fed members for a couple different reasons. We've had a big turnover, and they are looking at this big old wall in front of them. It's called inflation, and this is their main goal right now, is to get inflation down. But we started the year, all right around just under 2% inflation, and now we're at 7%, all right? And it could keep going up for the short term. If you recall listening to me throughout the year, I would talk about the Fed saying that inflation was transitory, and there's good reason to believe that it was. You had supply chain issues, you had the cost of lumber, the 3 L's. But you know what? Those things have not abated, and they may not abate for a while, all right? And the Fed should have started hiking rates sooner, all right? But they didn't, because they thought this was transitory, all right? And why did they do that? Well, you know what? I'm a history major. I majored in history. I'm a history buff, and history will help us understand and forecast the Fed's actions. So let's kind of take a look at that. In the 70s, I was a snot-nosed little kid running around getting in trouble, all right? Arthur Burns was our Fed chair. Inflation was raising a lot, all right? He said it was transitory. He was stubborn in saying that inflation was transitory. Year over year, inflation went up. It ballooned from 7% in 78 to 14% by the time he left in 1980. He was steadfast this entire period, though, that inflation was transient. All right, the higher inflation caused interest rates to go up from 12% to 18%. Can you imagine having an 18% interest rate on a home? We talk about high interest rates now at 3.5, 3.75, but bro, 18%, that's nuts. All right, in comes Paul Volcker in 80. His goal is to fight inflation. He hiked the Fed funds rate from 11% to 20% in 2 years. Right now, our Fed funds rate is zero. It's right near zero. And we're hemming and hawing over raising the Fed funds rate by 1/4 point. Paul Volcker raised it from 11% to 20% in 2 years. All right, what was the result of that? Well, inflation dropped from 14% to below 5%. All right, because inflation dropped, mortgage rates sharply declined from 18% down to 12%. All right, but there are some consequences for this action. First, the S&P sharply declined, went down by over 30% during this time, and the tighter monetary policy, all right, put the U.S. in a recession in 1982. Now, why would we go into a recession? What is a tighter monetary policy? When it becomes tougher for businesses to borrow money, all right, they don't hire, they don't spend money on R&D. All right, with inflation and interest rates up high, and the Fed funds rate. The Fed funds rate is what they use banks use to lend money to each other and to small businesses. They're short-term rates. When they go up that high, businesses can't do that. They can't pay employees. They can't hire new employees. They can't invest. All right, so we fell into a recession in 1982. All right, then comes Alan Greenspan. A lot of us know Alan Greenspan. So in the 80s, I knew who Paul Volcker was, but I was just some kid in high school. I wanted to be the next Steve Alford or the next Joe Montana. In the 90s, all right, I was actually just starting my career in the Navy. All right, inflation actually doubled. Inflation doubled from 1.75% to 3.5%. All right, that higher inflation caused mortgage rates to rise from 7% to 8.5%. But unlike Burns, Greenspan, he took action mid-99 and he hiked the Fed funds rate another 1.75% from 4.75 to 6.5% in 1 year. Inflation responded in a good way. All right, inflation dropped from 3.5% down to 1. Mortgage rates actually dropped from 8.5 to 5.5%, and that sparked a huge refinance boom. Okay, so what were the consequences, though, right? Because for every good, there's a bad, the yin yang, right? Well, S&P 500 fell 50% from the spring to fall of 2000, and the U.S. entered a recession in 2001. Now, there were a lot of other factors that were involved here, all right? We had the dot-com bust. There were some savings and loan issues in that time frame, as I recall, and those all had an impact on the equity markets. But the Fed actions, all right, also had a huge impact. All right, so let's talk about today. Today, all right, under Jerome Powell, who was just reappointed as our Fed chair by President Biden, inflation increased from 1.75 in January to 7% at year's end. All right, and the higher inflation has caused mortgage rates to go up from 2.5 to 3.375, and these are conventional rates typically. All right, the Fed is currently tapering their purchases of mortgage-backed securities and treasuries. All right, they're not going to hike and reduce purchases at the same time. All right. The Fed has basically said, hey, we are going to taper our purchases and we'll be done by March. All right. And then they actually had said, hey, we'll probably start hiking the Fed funds rate in May. All right. But they've actually come out yesterday and said something that leads us to believe they're going to do this sooner. We'll get into that. And they're targeting 3 rate hikes in 2022 and possibly 2 or 3 more in 2023. All right. Inflation and interest rates are going to rise, and we should expect them to continue to rise until the Fed takes these actions. And if the Fed can tame inflation, well, guess what? Mortgage rates will begin to go back down again. All right, but they're not going to go down to 2.25 necessarily. They're going to come down from maybe 3.75, maybe even 4%. Hopefully not. All right, and they get back down probably into the low 3s. Let's recap so you can see a pattern here. All right, so Burns and Volcker, these are the 70s. Inflation was at 7 to 14. They went from 7% to 14%. Mortgage rates, they went from 12% to 18%. All right, Greenspan in the 90s. All right, inflation rose from 1.75 to 3.5%. Interest rates went up from 7% to 8.5%. All right, and now Jerome Powell, inflation this year, 2021, 1.75 increased to 7%. All right, that caused mortgage interest rates to go up from 2.5 to 3.375%. All right, so in response to that inflation, the Fed funds rate, Burns and Volcker, they increased a huge increase from 11% to 20%. The Fed funds rate, Greenspan went from 4.75 to 6.5. Now, Jerome Powell is talking about going from 0, where we're at now, to about 1% by the end of 2022. All right, what was inflation response to raising the Fed funds rate, inflation dropped in the 70s, it dropped in the 90s, and it should drop this year. What will the mortgage rate response be? Well, if history repeats, mortgage rates went down in the 70s, they went down in the 2000s after Greenspan raised the Fed funds rate. They should decline as inflation begins to decline. All right, what were the consequences though? All right, in the 70s we went into the recession. In 82, in the 90s and into 2000 we went into another recession as the stock market went down. All right, we've already seen the stock market not respond very well at the beginning of the year. Oh my gosh, it's been a bloodbath for the first few days of January. Okay, basically here's what's happening. The Fed is saying, hey, stand by. We're going to put a halt to this hot economy, and we're going to get the economy back in line and get inflation down. All right, could it cause a recession? It might. It might, because if they take all these actions at once, and they don't, our inflation reports are actually that we get, they're in the past. All right, the actions that we're taking today, we're not going to see those for a couple months. So they may do too much too quick. All right, and here's a couple wild cards that we have. COVID. All right, Omicron, this new variant that we have that has basically snarled airline traffic across the country. Anybody who traveled this holiday season probably missed a flight. All right, any other changes in COVID could have a big impact on inflation and then also on mortgage rates. The government still wants to stimulate the economy with more money. What happens when that happens? Stocks go up, mortgage rates will go up too, because that injection of money into the economy is going to cause inflation to continue to go up. All right, and it's going to make the Fed's job of corralling inflation more difficult. All right, and here's the other thing that the wild card is, again, and I talked about this already. How are the Fed's actions going to impact inflation? Are they going to do too much too quick or not enough soon enough? All right, and those are the things that remain to be seen. So what's the interest rate forecast? As I said before, interest rates, they've gone up already about 1/4 point in like 2 days. All right, the expectation, and this is from the Government Service Enterprises, the mortgage industry, National Association of Realtors, these are their prognoses? Whatever, you know what I'm talking about. They're going to go up this first quarter. They've already gone up. They're probably above 3.3% right now. Second quarter, they're going to continue to go up. Third quarter, they're going to continue to go up, but not quite as much. That is what they're all projecting. What we anticipate certainly is that they're going to rise over this first quarter, maybe a little bit into the second quarter, get up to about 3.75%, and then maybe start settling down. All right. Fed action, softer stock market, slowing economic conditions. All right. Those things going into the third quarter, the fourth quarter should bring rates back down. What does this mean for you if you're buying a home? Should you not buy a home? No, because rates are going to come back down. People are going to be clinging to we all cling to the past, right? I want the 2.25. I want the 2.75. Bro, you might get there, but be patient. All right? Do not pay to buy down your rate. Take the rate you got. All right? That has the least cost possible. All right? Hold on to that and then wait for the rates to come back down and refinance when the rates come lower. All right? Is that a boondoggle by lenders? No, it's saving you money. All right? So that you can get a lower rate and lower your payment when the timing is right. All right, so let's talk about the housing market. All right? The housing market is all about supply and demand. Demand piece, that's the people. All right? And I'm going to compare now to 2006 when we had our last housing bubble, because I still hear people saying, oh, we're going to have a housing bubble. Not so fast, shipmate. Probably not going to happen. And here's why. All right, 2006, 2007, when we had a housing bubble. All right, if you look on this chart, these are the number of births for each year generation. All right, in the prime age when people start buying homes is 33 years old, right around 33 years old. All right, 2006, all right, when the housing market began to crash, all right, we had less than 4 million people who were coming in that prime buying age. Well, let's fast forward to now. All right, there are over 1 million more people entering that housing market, that prime time to buy a home now. All right, and that million person difference isn't going to go away. All right, so there's a lot of demand. All right, just look at that. Regardless of interest rates, there's a lot of demand. All right, so now let's look at the inventory. All right, in 2006, 2007, there was a huge amount of inventory. Okay, lots of homes, not a lot of buyers. All right, now the last 10 years, all right, we average about 2.5 million homes of inventory a year. All right, but if you look at the last 10 years, we haven't even hit 2.5. We have been underproducing homes for the last decade, over 10 years. All right, and that is now we're starting to pay a price because there's just not enough homes. Builders can't build homes fast enough, and so the supply, all those people are looking at a smaller inventory of homes. There just aren't that many. All right, so let's look at inventory. All right, months of inventory is an indicator typically of whether we're in a seller's market or a buyer's market. All right, we're in a seller's market if months of inventory is 1 to 3 months. We're in a mixed inventory or mixed market if where it's kind of favoring buyers and sellers from 3 to 6, and then 6 to 9 is a big time buyer's market. The peak of the housing market before the bubble, all right, we were in a huge buyer's market, 9.6 months of inventory. All right, again, there weren't a lot of buyers. Now let's look at now. All right, for the past 4 years, past 5 years, all right, we have had low inventory. All right, again, you go back to that last slide, not building a lot of homes, but a lot more people able and in a position to buy a home. All right, this past year, all right, in green is Hawaii's. All right, the blue is national level. Hawaii inventory is always tight because we're an island. We don't have a lot of homes. All right, we're thankfully the state of Hawaii is not allowing builders to build wherever they want. They're trying to preserve our land. All right, so inventory's always been lower. 2021, all right, in December, actually November of 2021, all right, we hit 1 month of inventory for single family homes. Lowest I've ever seen it. All right, probably the lowest it's ever been. All right, and that's probably not going to change too much until we get to the summer. All right, so we're definitely in a seller's market, but inventory is low. And what is the impact of that? Well, home prices have gone up. All right, this is the Case-Shiller Home Price Index is the gold standard for appreciation across the nation. All right, over the past year, home price appreciation has skyrocketed. In Hawaii, the historical home price appreciation is about between 5 and 6%. All right, this is national. We're above this, though. All right, we're above the nation. Why? Because we're an island. All right, we kind of peaked out October, November, and I don't have those bars on here. We've kind of peaked out 20.5%. All right, some parts of the country, like us, like San Diego, they've been at 26% year-over-year appreciation. So home prices have gone up substantially over the last couple years. All right, home price appreciation. The forecast for 2022, again, this is across all the government service enterprises and the mortgage industry and other economists. The average forecast for all of them is about 5%. All right, so I think that's pretty low. I think it'll probably go up into the high single digits, low teens, but we'll see. All right, I'm forecasting it. I got an opinion, just like everybody else. We all got whats and we all got opinions. All right. So what is a forecast? All right, housing market is going to remain strong, but not as crazy as it was in 2021. Demand might decrease a little bit, mainly because interest rates going up, but it's still going to be strong. All right. Instead of having 20 people put in an offer on a home, you might have 5 or 6 people put in an offer on a home. Okay. Supply will increase, especially in Hawaii, as people begin to take their money and run. And also now with the FHFA announcing that they are going to it's going to cost more for people to buy investment homes and second homes. That is going to increase the supply because there aren't going to be as many investors or people buying second homes in Hawaii. Rent, I tell you what, it's hard to buy a home. It's even harder to rent. It's expensive to buy a home. It's even more expensive to rent. Rent prices this past year went up 17.8%. Okay? That's a lot. All right? And that's not going to change. Like I said, it's hard to buy a home. It's even harder to rent. You have no control as a renter. All right? And there's a lot of people trying to rent because nobody wants to live in base housing. All right? Especially with what's going on now. And I don't blame them. So they want to go live in town. And there just aren't enough homes available for them. All right, so forecast mid to single digit appreciation and still providing a great opportunity to grow wealth and to establish your financial legacy for your family. All right, so in summary, inflation, it's going to go up the rest of this first quarter and then probably start coming down. Rates, they're going to go up. They've already started going up. Probably go up to about 4%, and then they'll probably come down by the end of the year. Housing prices, all right, they're not going to depreciate. Don't let that arrow fool you, all right? That's the rate of appreciation. We're at 20% rate of appreciation, right, or 19%. It's going to start coming down, but it's not going to go negative. Homes are not going to depreciate. The rate of appreciation is going to slow from 19 to maybe 5 to 10, maybe 12% appreciation by the end of the year, all right? Which is still a phenomenal way to build wealth. That's my market outlook for 2022. And you know what? I could be wrong. And I hope I'm wrong in some areas. I hope that rates don't go up that high, but we really do need to we need to get control of inflation. You kind of heard what my opinion, what my market forecast is. What's yours? What do you think is going to happen with inflation this year? How about rates? What about housing prices? Let me know what you think. I'm actually looking forward to see what happens at the end of the year, and maybe I'm right, maybe I'm wrong, but I think I'm going to be pretty darn close to right. All right. Have a great day. Have a great year. Stay positive. Stay safe. Let's do this together. All right.